How do you define the value area using volume analysis? Next on the S&P Forex and Futures Weekly Trade Review. My name is Mark Principato. I'm the director of the S&P Forex and Futures training program here at SMBU. I also operate the website unconventionaltrader.com. What makes this video different is we're going to be looking at the value area as defined by volume. Why is this important? It's because it helps us with a particular setup. In fact, there are two setups based on this particular condition. So let's get into it. So what we're looking at here is our volume analysis tool. This basically shows us, this is the Euro-Dollar futures, and you can use this as a proxy for your spot market, and that is exactly what we do. We can trade the spot market off of this information. Now, this is a very unique perspective that you cannot get from a price chart alone. These are not regular candlesticks. What you're looking at here are basically periods of time that are defined by the software. So in a very fast market, you're going to get more periods that close, or more bars. In a very slow market, you're going to get less periods that close. So obviously you're going to have open bars for much longer periods of time. That's important to understand. Now, the first step to defining our value area starts with the signal that we look for. And I've talked about this before. It's called the net reversal. What is that? Well, we look for a 200% net change between two periods. Okay? Net change meaning these numbers here. You have a minus 279 and the next period closes with a plus 270. Now, what is that? Well, you're looking at the aggregate difference between all the volume that was executed on the bid compared to all the volume that was executed on the offer. When you take the difference of those two volume columns, you get this net delta number. In this case, there were more contracts short in this period, minus 279, out of all these contracts traded. Now that doesn't mean anything by itself, but then the next period closes with 270 more contracts bought than sold. Now that is a 200% difference, and that is our first step, the net reversal. Now, once that is in place, we don't necessarily take a trade. What happens is we define what's called the value area. The value area comes from the three highest or lowest values of the period. In this case, since we're looking at lows, right? These aren't highs, they're lows. We're going to be looking at the three lowest values, which happen to be here. Okay? The price is 34.71 to 34.73. That area right there. That's the first part of the value area. The second part is defined by the three lowest prices of the previous time period, which would be this cluster of prices here. And that's 34.74 to 34.76 basically. Now, that entire zone, 34.71 to 34.76, becomes what we call the value area. The value area gives us a price zone reference to look for a trade. There are two particular things we're looking for within this price zone. Either what's called the value area retest, which means price comes back to the value area and bounces off, or the value area recovery, which means price goes below the value area and comes back up. Now in this case here, what we have is a value area retest. Now we don't know exactly what's going to happen once we get our net reversal, but let's consider the times here for a second. This period right here was about 50 minutes, okay? 50 minutes. Once that closed, this period here was about 3 hours, 2.5 to 3 hours. Now, during this 2.5 to 3 hour period, price tested the value area right there. Now, What our traders look for in a situation like this is once the value area is defined, we look for price to pull back into the area. In this case, it did, and it started to come off. When it comes off, that's actually a trade signal. We would consider it a very advanced trade signal because it's not very exact. You have to understand what the value area is, and you have to understand the type of trade that this is. This is not for swing trading or not even really for day trading. This is scalping. Okay? It can't be too precise, but at the same time, it gives you an area and you're just looking for certain types of activity in the area, meaning price pops off the area. That's a long. So the price that you actually may get filled is maybe 34.79, 34.80, somewhere around there. Now, as you can see in this case, let's consider the risk versus the reward. So if you got long, let's say at 34.79, once it popped off the value area, your risk is defined by the low, the lowest point, 34.71. So basically you're looking at 8 or 9 pips of risk. Okay, for a Forex trade, that's not bad, considering that the potential of these trades can be greater than 30 pips at times. In this case, the trade ran from basically that trigger area, 34.79, ran to 34.99.35. Okay, and it did that over the next hour, or actually a couple of hours. It took a little while to get there, but it got there. That's 20 pips versus 8 or 9. That is 2 to 1 reward to risk. That's not a bad trade. Sometimes these trades go further. You do have to consider time of day. This actually happened in the afternoon on a Friday. Not the greatest time to be taking one of these trades, but the important point of this video is understanding what this setup is and how to deal with it. You realize you could have gotten long around this 34.79 and it could have fallen through, and that would have been a stop out. But then what may happen is it may stop just below that and come back up into the value area. That is where you have to re-enter on the value area recovery. All right, and also if you do your analysis and this happens to be a major level, okay, if this area where the net reversal occurred happens to be a major level, that is what will allow you to hold the trade. That is what our methodology is all about. We have all these different particular setups and particular situations that allow us to make different types of judgments depending on what the market gives us. That allows us to anticipate trades and not chase and react to noise. So I hope you found this video helpful. For those of you who don't have the volume analysis tool, there are other ways to validate your trades using candlesticks and things like that. But this is a nice luxury, as you can see, because it gives you a lot of precision in terms of controlling your risk, and it can give you some very nice entry points to participate in trades that otherwise you would either miss or get in at much worse prices because you just don't have the precise information that is occurring here. Okay, so once again, if you have any questions, you can ask them in the channel here, or you can send me an email. We do have our training program. We have a lot of exciting things coming up that we're going to be talking about with our training. We're going to make some very exciting changes, so stay tuned for that. Also, every Monday and every Friday, as you know, I upload a new video. Monday is my weekly analysis. Friday is my weekly review. So make sure you check these out. They come here on the YouTube channel first. So I'd like to thank you again for watching. My name is Mark Principato, and I will see you next time.